Welcome to OFN's Connect Plus webinar on CDFI scenario planning. I'm Lisa Wright and head up OFN's investment and portfolio management team. In a minute, I'll turn the presentation over to Natalie Gunn, CFO at Momentus Capital, Christina Travers, CFO at LISC, and Rodrigo Vela, CFO at IFF. OFN is deeply grateful for these leaders for sharing their expertise and taking the time to be with us today. For the agenda, first, Natalie will provide an overview of scenario planning and describe Momentus's approach. Then Christina will narrow in and focus on financial risk analysis and scenario planning. Finally, Rodrigo will further narrow and discuss his approach to portfolio and liquidity scenario analysis.
Good day. I'm Natalie Gunn, the CFO of Momentus Capital, and I'm happy to share with you today. Scenario planning is a method of exploring and preparing for multiple plausible futures by identifying uncertainties and their impacts. The tool is extremely relevant and powerful in situations when an enterprise is facing significant uncertainty due to external developments wherein speed and trajectory of the development are unknown, and potential outcomes can vary widely, with almost equal probabilities of emerging. For instance, economic performance, for example, recession versus growth, or industry impact of new legislation. Often a company can feel powerless under these conditions. However, scenario planning empowers the organization to anticipate risks and opportunities, enables proactive decisioning, and enhances organizational resilience. Next slide, please. Conducting scenario planning is an iterative 5-step process. Step 1, identify forces impacting the business landscape to zero in on current certainties versus major unknowns or uncertainties. Step 2, formulate a base case scenario, which is based on current and known business dynamics. The benefit of the base case is twofold. It helps the company begin addressing immediate business needs, particularly if some disruptive trends have surfaced. And it also provides a baseline to compare the future scenarios to once they are developed, to help gauge how prepared the company is should a future scenario materialize. Step 3, select most dominant uncertain forces to build the scenario matrix. Step 4, we build the world for each scenario on paper. What does the business environment look like for each scenario? What are the impacts to our company? And what actions could or should be taken to address those impacts? And the final step is to assess company preparedness for each scenario and establish pre-scenario triggers to monitor. Next slide, please. Now let's get into the more details of each step. In step 1, using an environmental analysis framework such as Porter's 5 forces or Pastel-Steep, identify the forces shaping your industry space. Consider trends in the following areas as it relates to your company and industry space. They are political, economic, social, technological, legal or regulatory, and environmental. As you build this list, you'll find that some of those forces or trends are relatively certain and will continue. These will be the foundation assumptions for the base case scenario. Others will be true uncertainties in terms of trajectory and outcome. These will be candidates for the scenario matrix. Next slide, please. Step 2 is a critical step in strategic scenario planning. Ideally, before defining future scenarios for uncertainties is establishing the base case. This is a view of the current environment and suitable company actions or activities. The steps involve: develop your base case assumptions. These are a combination of business as usual insights, in addition to applicable trends or forces from your planning assumptions list. Secondarily, outline the business as usual actions. Keep the enterprise moving in an informed direction in the current environment. Next slide, please. Now the fun part. Step 3 is building the scenarios for the uncertain world. From the list of generating planning assumptions, select 2 dominating uncertainties, meaning they have an unpredictable trajectory and could vary widely. Ideally, they have minimal correlation so you can generate 4 distinctive worlds. For example, national economy health versus adoption of AI. Define the 2 extreme ends of the outcome spectrum for each axis. Next slide, please. For step 4, consider each scenario and describe the following: characteristics of the business environment, such as an investment or lending dynamics, impacts, implications to the company, and proposed action items to address those implications. Next slide, please. For the final step, once the scenarios are developed, you have the foundational plans to execute should any of them evolve. The 2 ongoing questions the business should then establish and monitor are: how prepared is the enterprise to react to each scenario? Establish a preparedness score based on the current company capabilities and base case scenario. How will we know if a scenario is unfolding? Develop a list of agreed upon leading indicators to monitor to determine conditions are moving towards a particular scenario. Next slide, please. In conclusion, I encourage your organizations to pull from any relevant areas from this presentation to apply towards your scenario planning during these challenging times, and I wish you all the best. Thank you.
Hello, everyone. My name is Christina Travers. I'm the Chief Financial Officer at LISC, Local Initiative Support Corporation. And today I'd like to take some of the information that Natalie just went through and kind of apply it to how we think specifically about the risk and scenario planning at my organization. Next slide. Where we've started is to look into the external environment and identify risks that have a potential impact on our organization. And in this particular time frame, and I'm just talking about now, it would be different depending on the environment that we're in. There's a series of political and financial risks that have impending or potential impacts on our organization. We LISC have a business of government contracting, so we have existing government contracts, and there's the threat that they will be canceled. Additionally, just within the ecosystems we work, there's the potential that government investment will shrink and it'll impact our partners in the markets we serve. In general, there's a lot of subsidy in the lending that we do across the United States of America, and there's been conversations and expectations of some shrinking there. As we all know and have spoken about, there's the elimination or the reduction in the budget of the CDFI fund. Some of these that I've just mentioned are on the shorter term side. There's also these longer term conversations on the political side about CRA and regulations, and also just the reevaluation of 501c3s and what that means. On the financial side, this is really like what's happening both politically and financially that could impact the organization. We're anticipating a bunch of unbudgeted expenses due to what's going on in the overall environment. We've also experienced some loss in government contract revenue, and that impacts our ability to do our programmatic work and also cover the back office infrastructure that is put in place to manage those contracts. There's the future potential of philanthropy slowing down. We fund a lot of our programs with private revenue. And so while we're not seeing that now, it's on, in our radar to look for in the future. Tariffs is another unknown in the present of what the residual impact will be. We're starting to see it, but that really we anticipate will have negative impacts on our lending and our loan portfolio as a primarily real estate lender. We also have tax credit affiliates. We do a lot of investing in new market tax credits and low-income housing tax credits, both of which could be impacted by tax reform. Doesn't look like that now, but it's something we don't want to leave our radar. Moving on to the next slide. So after kind of doing an environmental scan of like what's out there that are like near-term and long-term threats, it's then turning inward. What are the key drivers of how we operate our business that could be impacted by those threats, right? And so I talked about it a little bit in the context of the environmental risks, but just to make it even more clear, there's 3 categories where we see the most potential impact, right? Support revenue. We do a lot of programmatic work outside of our lending. And so, as I mentioned, there's government contracts, that's private contributions. And then though we don't get a ton of direct general operating support, that's really important to support our infrastructure. Earned income, net financing income, the performance of the loan portfolio also is a key contributor of revenue. We also have diversified over time into affiliated and wholly owned companies that do other charitable work that aligns with LISC's mission. We also get some financial benefit from having those. For example, our low-income housing tax credit syndicator, as well as our new market tax credit syndicators. On the expense side, all of the things that we're looking at do have the potential to have expense impacts. We could end up spending more on legal costs, on policy to get out into the world and tell our story, and find new partnerships and new administration, and then just the unanticipated increase in the cost of goods and services. Some of that's from tariffs, and other contributors, which I mentioned on the previous slide. Next slide. So now that we've kind of like looked at the world, looked at where we think it's going to impact us, we're able to move into like the scenario planning and modeling. And really that's starting with the fiscal year we're in. We happen to have a fiscal year that's on the calendar year. Everybody's a little different, but maybe that will or will not help, because we came up with a budget for January 1st and quickly knew maybe about 20 days later it was going to be a different year. And so what we're trying to do in real time is build scenarios so that we can adjust our financial expectations based on what we're experiencing, but also projecting to see happen and impact our financials in the short term. This is iterative. This is not a comprehensive budget reforecast. This is just trying to keep on a day-to-day basis, look at a high level of the things that are and will potentially impact our financial performance that causes a variance from our original budget. So scenarios generally have a best case, a worst case, a base case, a worst case, a best case. You can take it as far as you want based on the number of factors you're dealing with or the range that you might see. But one way or another, the way that we're looking at it is a base case is the precursor to a more extensive and comprehensive forecast, right? It's the best understanding of how we think things are going to go. We kind of maintain that base case and are iterating on it on a regular basis, but then we're moving that into quarterly financial reforecast. The importance there is like we can't get to every single line item in a comprehensive way on a daily basis, right? We're doing that for the big shifts we see in the external environment that have an impact on the factors we've identified in the short term. But then we're looking at overall trends in our business on a quarterly basis, thinking about how those may be impacted in an indirect way by the larger factors we've identified in scenarios. And so we're doing that, right? We're still in the earlier part of the year. So at this point, very focused on how's FY25 going to go. But as the year progresses and as we kind of get a better sense of what the new normal is and where there's still variability, we'll be using this modeling beyond 2025. Next slide. So just a little bit more about the scenarios that we're looking at this point. I said in the last slide, like you may have 5, you may have 2. It just really depends on how your business operates and how much you want to look at and distinctly or altogether. our base case at this point is looking at the financial impact of the events to date, of which there have been many, and then looking ahead, what, like, based on that and things that we're seeing in the external environment, what can we expect this year to hit? It's a look at the associated expenses and also the indirect expenses of those impacts, but also, like, we're making changes and we're acting upon things that are happening. And so there's also some upside. So we may decide, like, because this has happened, we want to, put in place some expense management measures, right? That's going to have an upside. It's not all like the negative impacts, like everything's got a push and pull. And so want to make sure that we're really accounting and thinking about where there's opportunity for upside when there's going to be down. The worst case is more aggressive. Generally, I mean, ideally, the assumptions are variations on a base case theme, but assuming that things will get materially worse. Best case is your stretch goals are achieved. And, for us, and it may be different for you because of your variables and your business drivers, right now I'm finding that less relevant, right? And, the base case is what we're hoping and trying to manage towards. So less relevant in a high risk environment, but still an important part of the narrative. Next slide. Okay. So, I talked a bit about the forecast, and this is really just the staging between, we've been doing scenario planning, things are happening, we're keeping track of it. But at some point in time, how does that look with everything that's just business as usual? Because in any given year, even in a lower risk environment, there's going to be changes to what you thought and what actually happens. And so, as I mentioned, we take our base case and we're moving it into a forecast. And that's on a quarterly basis for us. Others may do that monthly. Others may wait until the halfway point of the year. It really just depends on what makes sense for you, your governance and your oversight. It's the way that we look at it on the base case now is it's not really to replace the approved budget. And there'd be circumstances in when that would make sense, when there's just a material change in your business model, or it's really your discretion when you decide to do like a reapprove budget versus a forecast. I personally like to keep the original budget and go to forecast when possible, because then you just have that perspective point to like keep going back to like what changed and why and what are we seeing, and it provides a narrative of how the year has changed from what you originally thought. There are circumstances in which that no longer makes sense because something good or bad or just big has happened, and you really need to think about approving a new budget. Ultimately, that forecast becomes the new base case, right? And that's where you start after the quarter is over and you've, kind of come up with a comprehensive forecast. We're just going right back into scenario planning in the short term while we wait for another quarterly result and do that comprehensive analysis again. For us, that's really about our cycle and our process, but it's also just about, it's a big body of work. We've got, we're a national organization and we've got a lot of different business lines. And so getting into the details for us makes sense on that basis. Next slide. All right. So, I've been talking about, the income statement, and, that's as good as it is in the context of this year. But in a high risk environment like the one we're in now, there's also the balance sheet, right? And so really, when you start to get into multi-year forecasting and thinking about the fact that this isn't something that's probably going to be over in this fiscal year, we're also looking at our balance sheet strength for beyond FY25. And for us, we're really trying to make sure that we're leaving a cushion, because we know what we know about the things that have happened. We're making calculated assumptions about what we think is going to happen in the rest of this fiscal year. But looking beyond is really challenging in the environment we're in right now. For that reason, I can't tell you what's going to happen, but what I do know is that I want to make sure we're able to maintain a cushion for that. For us, that's really looking at our operating expenses against our liquidity. Our liquidity, comes in different forms, or like how I'm looking at it is different, is we have an investment portfolio, want to make sure that we have opportunity for liquidity there to cover our operating expenses. You know, we're also looking at our debt portfolio that we use to fund our loans, and thinking about how much new and renewed debt we're going to need, because, you know, as there's downturn in the economic environment, often, you know, there's a capital crunch with the institutions from which we borrow. Want to make sure that we're not depending entirely on things that may not be available. Do we have enough debt to manage our portfolio? Also kind of thinking about and scenario planning on the loan portfolio alone in terms of asset quality. I mean, you know, changes in the performance of the loan portfolio impact net financing income, but it also impacts our provisioning, our expected losses. And so kind of a deep dive on that, and like stressing that on a more long-term way, because in this particular case, we're not expecting huge deterioration this year, and we're planning for that to never be the case, but also want to make sure that we're planning for, you know, a prolonged stress on that portfolio. Last but not least, you know, we're also trying to keep in mind in the long term these other things that are a little bit further from like an ability to tangibly forecast for now, but we know will have impact on our business line and the communities that we serve, specifically tariffs, tax reform, and the general economic environment, and our opportunity to get enough revenue to cover the cost of operating our organization. In conclusion, today I've given some examples, some of which are very specific to my organization's business model. And as we know, CDFIs have all kinds of different business models. But what I was hoping to do was to kind of take a framework and show a practical application. I hope you found it helpful, and thank you very much for your time.
Thank you, Christina, and thank you, Lisa, for inviting us to participate in this webinar, and as well my colleague Natalie. My name is Rodrigo Vela. I serve as the Chief Financial Officer for IFF, and happy to join in and participate here on this webinar. Megan, if you want to go to the next slide. The intent here is just to model different variables of scenario planning, and just to share with our colleagues in the industry what are we doing in a practical matter to see how should we address the different scenarios that are coming down, right? So what we do is we typically emphasize liquidity and capital, and as far as capital availability, liquidity, and then obviously a capital base in the sense of net assets, right? Big drivers for what we address in our models is, okay, how are our disbursements going to play out in the next 3 years, and how are the payoffs going as we play out in the next 12 months to 24 months, because, you know, depending on the size of the balance sheet that you have, and depending on the maturities of the loans, sometimes we could have, in our case, maybe $80 million or $100 million of current loans in the balance sheet that we anticipate that they're going to pay off. But well, what happens if the borrowers need a refinance, or if there is delay in the takeouts of those loans? So one of the drivers that we do to stress this out is, okay, what happens if the payoffs are reduced 50%? What levers are we going to need to pull, and how are we going to react if those changes, right? The other piece that we conduct is for the growth that we anticipate having, and you know, over the past 3 years, IFF has been disbursing substantial capital into its footprint. So if we want to continue on that growth trajectory, okay, how much capital are we going to be needing annually, depending on those payoffs and depending on those disbursements that we're targeting, right? We're having a number of loans that are coming out and that are paying from our borrower base, but as well we're growing. So what that capital base is going to be needed. We're going to need 20 million, 40 million, 100 million a year. That all is going to be informing the capital raise that we will need, and then obviously who those funding sources are going to come from. And these two that we're stressing on the balance sheet side. Then another factor that comes into play is, okay, what happens if the net interest margin is compressed 100 basis points, right? Is that going to impact our profitability? How much? Typically, we have covenants of profitability, making sure that we have net income 2 out of every 3 years. So we always want to ensure that we're running on the black. And then the other factor that we stress as well is the allowance for loan losses, right? What's going to happen if, for any given reason, we have to charge off 150 basis points on our portfolio. On our end, we have the discipline every ONL budget to do then a 5-year forecast, and then as part of that process, we do some stress scenarios. And what would happen if we go, and depending on the size of the balance sheet and depending on different factors you want to stress, you want to stress the reserves. And then the consequence of that piece on stressing the reserve is that then that is going to impact, okay, now you have a less allowance for loan losses, and there might be, depending on the lenders that you have, some minimum thresholds of allowance for loan losses. So then the charge of it is going to be one implication, and then most likely you're going to have additional expenditures on the allowance. So that is going to be then managing the other pieces on this front. The other big important scenario that we are always keeping an eye on is on the portfolio quality and the delinquency of our loans, and making sure that they stay within the covenants that we have with all our investors, right? A scenario of what would happen if those delinquency thresholds would be beyond what we have in our guidelines, then you would have, okay, impact on the credit availability because capital lines would probably freeze. You want to make sure if you are running into that scenario to be fully liquid. And then also have in mind how that new originations are going to be impacted if in the event that the portfolio quality of your CDFI starts deteriorating. Let's go to the next slide, Megan, please, so that we can talk a little bit about the asset to liability matching and the liquidity. And on this front, the way that we want to consider is, okay, that there are 2 bars here. One is our lending capital, and the other one is the committed capital that we have with the borrowers. We want to make sure that we always have greater capital than the committed capital that we have. So on your right, you have the lending capital available. And on this end, I'm putting in an example of, I think, around $100 million of capital availability. You have some net assets for lending and that outstanding, and then that credit availability is super important to have at any given time from your lenders, right? There is this balance of having cash on the bank and minimizing the negative arbitrage. So we want to have always capital on lines that you can pull at any given time, so that we can fund On our end, we do a lot of construction activity, as obviously most of you do, and most of our peers in the industry. So when we get that request from the borrowers, we have that. And we have that capital available to be dispersed. On this particular example that were presented, you'll see the bar on the right is almost as big as the bar on the left, which is the committed capital. And that is because we are including another piece of loans that are approved, but not yet closed. And basically, this example is just telling us, hey, there are a number of loans, in this case, $11 million in loans that we have approved, or that this entity has approved, that are about to be closed. So the capital raising machine needs to be plugged in so that the organization can have the capital to close that loan. And then the second piece that you have here is we want to make sure that we have a duration gap between the liabilities and the assets, right? So that we always receive the cash from our borrowers before, so that we can have the money to pay our lenders. In this case, IFF is a long-term lender, or this example is based on a long duration of capital. So you have 10 years on the lending side and 9 years for the commitment. So if you think about what happened to Silicon Valley Bank when they went under, they basically had the duration the other way around, with a very short term on the liability side. The duration of the deposit was quite short, and then the committed one was quite long. So we want to make sure that it doesn't happen, or it doesn't happen to us. And that way, we're not that concerned of, okay, how much cash do we have in the bank? It's not about the cash on the bank, but it is about the capital that the organization has available from its credit facilities, its unrestricted net assets for lendings, and the different sources that it can pull down. And this is the way that we manage the liquidity and the assets to liability matching. Then, in addition to this piece, we run a 12-month monthly outlook with all our principal payments, interest expenses, operationals, and so forth. And we incorporate then all the pipeline of the capital that we are raising. So what we want to ensure is that at all times, the organization has the necessary capital to pay and to satisfy its scheduled obligations, right? If we have debt that is maturing, then we have the capital available to satisfy that debt, because there might be some time in which the lender is going to say, you know what, first pay me, and then I'm going to renew that facility with you. And you want to make sure that we have that capital, in that cash in the bank, to say, yeah, here is your 5 million. Send me 10 million more in a couple of months. Hopefully these thoughts are helpful to you, and happy to answer any questions. Feel free to shoot me an email if you want. Rodrigo Vela, and my email are vela@iff.org. Thank you, and have a wonderful day. And thank you, Lisa, again, and my colleagues for joining us on this webinar.
Thank you for watching today's presentation. We hope the information has been helpful as you approach your own organization's scenario planning. This recording, including some of the templates discussed during this webinar, will be available in OFN's members-only section on CDFI Connect. If you do not already have a CDFI Connect account, you can register for free and join a community of over 13,000 practitioners in the industry by visiting www.cdfi.org. www.cdficonnect.org. OFN's members have access to a dedicated members-only community and resource library. The link to the resource library is on the slide, and if you can't see the resources on that page, make sure you've logged into your account. If you have any difficulties, you can reach out for support at community@ofn.org. Additional scenario planning resources will be available in OFN CDFI Practitioner Resource Library. The link to this library is on this slide. This slide also lists other ways to stay connected with OFN and take advantage of learning, networking, and professional development opportunities. Please reach out to Development Services team at developmentservices@ofn.org for more information or with feedback or questions. Thank you again for watching today's presentation.